Greetings, traders, and welcome back. Thank you for joining me for another In-Depth with Chris episode. Today's subject, we will be talking about trailing stop orders, mostly as it pertains to the concept of a trailing stop loss. We will cover both trailing stop orders to buy and trailing stop orders to sell. But other than that, the trailing stop loss is one of the tools that can allow us to optimize our profits while potentially managing risk. And as such, I thought it was important that we cover this one as well. But before we get going too deep, let's show you how you can apply the trailing stop loss concept to your charts on the Finamark platform. That way, those of you that are ready to pass the Gauntlet Mini know how to use it. There are two ways to implement a trailing stop order, and the first is by just clicking the order icon up here in the top right. Now, if you click this button, you may have to implement all of your account and symbol settings, and it may not be auto-filled for you. There's a faster way to do it as well, and that is by simply clicking the sell market or buy market button down here, because it will not immediately open the order, but instead what it'll do, as long as you have your one-click trading off, it will open up the account with the pre-filled settings, and we can modify everything from this point thereafter, which means if I have a sell order and I would like a stop loss applied to my position, as I come down here where I see my order type is market, if I want to change it to limit, I can, but we'll leave it at market. And if I set myself a stop loss by clicking on this button, it'll turn red, and then I can type in how many ticks I want it to trail behind price. Now, we're going to talk about exactly what this means, so don't get overwhelmed just yet, but this is how we would implement it. Now, once again, the same thing would be had for doing a buy. It would just be the exact opposite. Instead, we'll click the buy market icon. Once again, we'll decide if we want to do it as a market or a limit order. Then we'll click the stop loss button down here, and then we will just type in however many ticks we want as far as the trailing stop loss goes, and then eventually we'll click confirm. But other than that, let's dive on into the material, folks, and learn a thing or two about trailing stop losses. The trailing stop order has been a concept that has been around for some time in the trading community and is widely considered to be an acceptable way to mitigate some risk in the market while also allowing yourself unlimited potential future gains, assuming the order does not trigger against you. Put simply, a trailing stop order is usually used as a stop loss technique in the way that it stops the amount of loss that we are allowed to take on any particular position. The way that it does this is by setting the amount, whether it be by a specified number or a percentage. So it could be a fixed value in an asset's movement, or it could be by a percentage of the asset's overall value, but it is going to trail behind in whatever direction our order is. So in the event that we were to place a buy order and we wanted to set a stop loss, it would look something like this. On the left here, we can imagine this yellow line. This is the stop loss order. And we're going to say that this distance represents, say, 10 pips. Well, if the market were to move downwards 10 pips after moving upwards 10 pips, we would see our trailing stop over here on the right would have moved up to this location, and we would be stopped out if the market has now moved down 10 pips, because it is going to trail behind by 10 pips and it never goes backwards. Okay, so it never goes backwards. This means that the trailing stop loss, whether we're in a situation where we're looking to use it on the way up to get out of a position to lock in those long gains, or whether we're shorting the market and we're using it to get out, the stop loss is never going to go farther than the amount that we limited. That means we can never lose more than the amount that we set the stop loss that it's going to trail. We can never lose more than that specific amount. When deciding to set a stop loss, some platforms will allow you to either do it as a value base or a percentage base. So we're going to take a moment to talk about exactly what the difference is. With the value base, this just simply means that we're deciding that the degree of decline that we're willing to accept is based on a specified value. It is an exact number. Whereas with the percentage base, we're talking about a percentage that we're willing to accept in regards to the degree of decline in whatever it is that we're looking at. So if we look at an example with the value, if the current market price was say 180, then we could set our trailing stop loss to a fixed $20. That means $20 below 180, and it is constantly going to go up in that $20 segment. Now, that does not mean it will only go up in $20 intervals. To clarify what I'm saying, that means that if the price were to go to say 181, now the trailing stop loss is going to also go up $1 behind price, if that makes sense. So if the price were to rise to say 210 in our original example, our trailing stop loss would still be $20 below 210. That means no matter what, it is always going to limit us to $20 of backward slippage. Understand? Now, as we work our way into the percentage, in this case, if we place the trailing stop loss at a fixed percentage, say 20%, then obviously in this scenario, the most that we're willing to let the market draw against us, whether we're long or short, is going to be a 20% difference. Now, understand there is a very big difference between 20% and $20. So if you are on a platform that is going to allow you to do a fixed value or a percentage, make sure you are writing in something and understanding what you're writing in, because if you did a 20% stop loss versus a $20 stop loss, that could be a massive difference. That could be a very large difference. So we always want to make sure we're paying attention to whether it's a value or whether it's a percentage. We can use this graph to help illustrate and understand the concept behind a trailing stop loss, or a trailing stop order as it should be more correctly worded. The idea here is, if we were to imagine that we were in a long position and we were interested in this XYZ stock, or it doesn't matter, the idea is we're interested in the market rising. So we bought in at say $20 in this scenario. If we bought in on the one at $20, the next thing that we would do is we would, at $22, we're going to set ourselves a stop loss, but we're not just going to set a simple stop loss. We're going to set a trailing stop loss, because we don't want the position to just give us the ability to come back to a predefined stop and close out. Instead, we want our position to continue to have growth potential, but also to lock in the gains without the ability to lose them that we might have with a predetermined stop loss at the time of an entry, or right around the time of an entry. So what we do is, as the market price, remember we're long here, as the market price reaches $22, we're going to set a $1 stop loss. That means right here represents our stop loss, which at first looks normal. But remember, instead of doing a regular stop loss, we're interested in doing a trailing stop loss. So it's a $1 trailing stop loss. So what this is going to do is it's constantly going to stay $1 behind the highest point that price achieves. So as we reach this peak up here, which we can call $23, we notice that our stop loss is now following along and is now up here as well. And this number 4, the stop loss location, will never ever go below. We can never lose or have our position close out unprofitable at this time in theory, because we will not accept a position price that is lower than $22 in this case. And remember, we got in at $20. So in this scenario, we have our stop loss moving up as price moves up, constantly increasing our permanent profit that we are locking in. That's the concept. So as price continues to rise, over here we saw it go to $24. We then saw the stop loss move its way up to $23, which would have been right here. At this point, the market started coming down against us. Oh no, that's not what we want. But guess what? Our stop loss does not back up. It holds its ground. And if price crosses this threshold, if it falls backwards more than the $1 that we allowed, then all of a sudden we have now closed out at a price of $23, which means we locked in our gain from $20 at the very beginning to $23. That's the concept of a stop loss in a long scenario. If we were to just use our imagination, we could see how this would work in a short scenario just the other way around. If the market was working its way downward and it had a few upswings along the way, but nothing larger than $1 if we did the same thing. Say we shorted up here at $20, and at $18, we set ourselves a $1 stop loss, which would be somewhere in between. Remember, that would be our $19 position where our stop loss would currently be sitting, but it is always going to stay that $1 behind price like we did on the way up. Well, as price moves downward, remember, so does our stop loss. So if this represents, say, $16 down here, now all of a sudden at $17 is going to be where our stop loss is sitting. If price ever goes backwards up to a $1 increase from the lowest point it's ever achieved, it's going to find a way to hit that stop loss and we will be closed out, which means in this case, with our poorly drawn example, we will be looking at a $1 increase to a $16 closeout. So we gained $4 in terms of our short sell scenario. So remember, it is just going to follow behind the most extreme of the direction that we are anticipating the market to go. Trailing stop orders can also be used to determine when to execute a buy or sell order as well. If we were to imagine that we were looking at a trailing stop sell order during a long position, if we're anticipating the market to be going upwards, we can set a trailing stop sell order so that we don't just simply exit when the market falls backwards against us, but we actually get in to go the other way and take advantage of future downward momentum, hopefully. That's the idea behind the trailing stop sell order if we are going long. Now, in a trailing stop buy order scenario, we'd be doing the same thing just the other way around. So once again, instead of just saying, hey, we're short, we want the market to close us out if it draws back upwards too much against us, instead we can say that we're actually looking in for a buy or jump in for a buy at the point that we cross that threshold. Instead of just stopping out and being done with the position, we can flip long in that scenario as well, and that is done with a trailing stop buy order in a short sell scenario. Now let's take a moment to imagine a trailing stop buy order example and just really understand the concept here without the help of any more graphs. Let's say that I'm interested in borrowing a Bitcoin so I can sell it from a broker. So instead of just actually buying my own Bitcoin, I can use the broker's Bitcoin to sell it. And we'll say that I got it at a price of, say, $9,500 to sell. Well, the thing is, I need to return this Bitcoin to the broker at some point. I'm only using it as a way to get money. Now, if I'm interested in holding on to this Bitcoin, but I need to pay the broker back and I want to limit my risk, what I can do is I can set a trailing stop buy order with a price distance of $300. So if I have a price distance of, say, $300, that means that if the market rises to $9,800, the most amount of money that I'm going to lose is $300, and then I'm going long. So if I was initially selling from $9,500, but I gave myself $300 of slippage, giving myself this $9,800 ceiling, and then I'm going long, no matter what, I'll be able to return the $9,500 Bitcoin to the broker because in this scenario, I'm going to lose $300, but then I'm going long with a Bitcoin. So that is a buy order example with the addition of a trailing stop. So that's a trailing stop buy order example. Now let's assume a sell order example with our same Bitcoin ideology here. If I were to open a long position after purchasing one Bitcoin, so I bought a Bitcoin, I own the entire thing, I own a $9,500 Bitcoin, and I'm long on the Bitcoin, but I don't want to lose any more than, say, 5%. So I don't want to lose more than 5%, which would equate to $475. So I don't want to lose more than $475 on the position. So the way I'm going to go about this is by setting a trailing stop sell order. So with a trailing stop sell order, I can give myself a fixed percentage distance of that 5% in a falling market. If the market price declines further and the bid price drops to, say, $9,025, the stop order will be triggered and automatically place a market sell order. But if the value of the asset keeps rising, well, then our position and our profits are still secured since the trailing stop price is going to move along with the market price at the fixed percentage of deviation of 5%. So if the price of the Bitcoin were to rise to, say, $10,000, well, then the triggering price would rise to, say, $9,500 as far as our trailing stop in this scenario. And this is nice because at this point, we stand to lose nothing once this occurs. So in conclusion, stop orders can be used to get us out of the market, but they can also be used to get us into the market. Usually, most of the time when someone's referring to a stop order, they're referencing a stop loss, meaning they're not looking to just flip the other way, even though that absolutely is possible. Most cases, traders are just simply using it to trail behind and close them off and look for an entirely new trade once they've gone flat because of the stop loss. It's a very useful tool because it can allow us in grindy market conditions to very safely follow the price movements and continue to gain if we are correct in our position while increasing our stop all the way without having to worry about managing it. That means that our potential gains can continue to rise without worrying about ever going negative on the position or having all of those profits wiped out, because it keeps benchmarking them in for us. But other than that, I strongly recommend, if you are a new trader, checking out the trailing stop loss, because any stop loss usage, in my opinion, is better than no stop loss usage at all. And in the meantime, folks, please make sure you do me a favor and just click the like and subscribe button down below, because it helps us out a great deal. But until next time, folks, happy trading. I will see you all very soon. Cheers.